So the global environment remained pretty solid in November. The macro data that we saw was pretty good, particularly in Europe, where we saw stronger growth and still subdued inflation expectations. In the US, the growth was also quite good. And again, inflation has yet to really materialize to any meaningful extent. This has given central banks some room to maneuver in terms of their trajectory for monetary policy. Markets were fairly quiet overall, with global equities up only about 20 basis points in the month. We saw a relatively strong performance at the start of the month, but we saw a few jitters coming in around political events that meant that markets sold off towards the end. In emerging markets, we saw them give back a little bit after what has been a pretty strong year so far. From a long-term perspective, we don't think that's anything particular to worry about, but it's worth noting that as equity markets look forward to 2018, we need to see a continuation of the strong momentum, both economic and corporate, that we've seen over the course of this year. Two things worth talking about in the US. First, on the monetary policy side, is the nomination of Jay Powell as the new chair of the Fed. He represents a continuity candidate, we think. He's been on the Fed board for a number of years, and we wouldn't expect to see any meaningful shift in monetary policy from him. Finally, around tax reform in the US, it now seems likely that we will see a tax reform passed in the relatively near future. Whether it's this side of Christmas or not is a little bit academic. And that should translate into lower tax rates for corporates, whatever the final number ends up being. And markets have taken that relatively well. We think it reflects a hope that it could translate into stronger economic growth and also potentially into increases in terms of capex. If we look back at 2017, or at least the first 11 months of 2017, it's probably fair to say that markets have performed a little bit better than people might have expected. We've seen stronger growth, very low volatility by historical standards, and that's translated into good equity returns. When we think about 2018, what we really need to see is a continuation of that backdrop. A good macro tailwind translating into strong earnings growth, strong profit growth for companies, and a benign environment, particularly on the inflation side. If we think about 2017, what we saw was inflation that was a little bit weaker than people had expected, particularly in the context of relatively low unemployment. So when we think about 2018, we need to see that continue because we think it gives central banks the opportunity to normalize monetary policy at a fairly gradual pace.